Today on the podcast, I'm going to be talking with Spencer Murray. He's a local mortgage broker in London. Going to be talking about 30-year amortizations, changes to mortgage rules coming in very shortly, and those Trump tariffs. Going to get him to talk about his opinions on what he's been seeing over the last little while with mortgage rates and where things could go in 2025. Welcome back to the London, Ontario Real Estate Podcast. Today, I have a very special guest on the podcast, someone who's joined the podcast before to give his insights on mortgages, because this is something I get lots of questions on, but I always say, hey, talk to the experts on this. Welcome back to the London, Ontario Real Estate Podcast, Spencer Murray. Spencer, how's it going today, man?
Not too bad. Thanks for having me, Phil.
We were just talking about all the snow we've been shoveling. London got hit pretty hard. We are into December now, so we can see the horizon, I think, of 2025 coming quickly. I'm getting a lot of questions about these new mortgage rules. Some clients were asking me just last week, I think we were talking about a couple that is looking to make a move, but they need a 30-year amortization, or they want to consider a 30-year amortization versus their current situation. Tell me what you're seeing, I guess, in terms of what's going to be happening. I think December 15th is a date some people are watching. Can you tell me a little bit about that, Spencer?
Yeah, so December 15th is the date. You are correct with that. So what's going to be happening on that date is insured mortgages for first-time homebuyers and anybody who is purchasing a new build home will be able to extend their amortization out to 30 years. So an insured mortgage is, one with less than a 20% down payment. So anybody who has a less than a 20% down payment will be able to extend the amortization on their mortgage out to 30 years, which could lead to, or most likely will lead to, higher affordability for those buyers. So we might start to see more buyers creep into the market.
So is that something that they can apply for right now, or do they have to wait for December 15th?
The advice that we're giving and that we've been told is to wait until the December 15th date, and it may even be after that, just because we want to make sure that both the lenders and the mortgage insurers have their systems in place to be able to accommodate the 30-year amortization. My gut tells me that they will have it in place, but you never know if they may need to work some things out before it kind of goes mainstream.
So that's a kind of a conversation you could start having with clients now, I'm guessing, Spencer, and then kind of when they get into December 15th, you can kind of advise them on the numbers that you're seeing. Does that make sense?
Absolutely. Yeah, I've been doing that lately with free approvals to say, okay, based on today's numbers and the limitation of a 25-year amortization, this is what your overall affordability looks like, or your max purchase price. But, come December 15th, and once all the systems are in place, then this is what your affordability could look like. The one thing to keep in mind with these insured 30-year amortizations is there will be an extra insurance premium. I believe that premium is going to be 0.2%, so 0.20 additional to the existing insurance premiums.
Okay, so you're going to be getting hit with a little bit more insurance premium on that one, so you have to consider that when you're looking at your costing for sure. One of the things I'm also noticing too, tell me about the down payment requirements, because my understanding as well is that there's some change to down payment requirements, especially I think we are looking at houses that are a little bit more on the expensive side. Can you tell me a little bit about that? I don't want to, I get questions about it, but I just want to talk to the expert on something like that.
Yeah, so also on December 15th, the maximum price for insured mortgages goes from under $1 million. So initially it was $999,099. It will be increased up to $1.5 million, which may not affect us here in London. It's more for the bigger markets. And so we'll see that might help people get into the market in those larger markets. But the minimum down payment, so a lot of people think, minimum down payment is 5%. However, that depends on your purchase price. Minimum down payment is 5% on the first $500,000 in purchase price, but it's 10% on the difference. So, for example, if you are to purchase a home for $600,000, your minimum down payment is $35,000. So I prefer to refer to it as minimum down payment versus 5% down payment.
Yeah, that makes sense. So yeah, you don't want to go in there and just have your small down payment and think you're going to buy $1 million house today. So you have
Correct.
to look at the numbers. Yeah.
On on that $1.5 million purchase price, the minimum down payment is $125,000, and rough minimum combined incomes is about $280,000.
Yeah.
So
that's still, I mean, it seems like the government has hit us with a bunch of changes all at once. Do you have any sense of it seems like they're trying to make it easier for people to enter the market in a lot of ways, not to get political on the podcast, but I think it's interesting because it still doesn't really help with building of new homes that people actually need, like smaller, bungalows or something. I feel like I could sell a lot of those pretty quickly. But it seems like the demand side has been potentially increased even more with all these changes. It's just all at once. I think we're seeing even more change happening. Any thoughts on that, Spencer?
Things are coming pretty fast. I'm not going to lie, and it's tough to stay on top of. I mean, there were some recent changes back on November 21st as well with regards to no stress tests on renewals. So that would be, if a client is taking their mortgage to a different lender at renewal and they didn't need any additional funds, so they didn't want to take out any equity, they're not subject to another stress test. So, they can qualify for the mortgage just at whatever the contract rate is or the rate that they would get. They did this to allow for, more competition and potentially better rates between lenders. However, there's a bit of a caveat to it. It's lender specific. So some lenders are still choosing to qualify buyers at, contract plus 2 or what might eventually come back as the MQR.
That means that if I have a mortgage in place, though, I can shop it around. Is that when I go up for renewal? Is that the idea of that?
Correct. Yeah, you could always do that at renewal. However, it will be easier to qualify. You don't necessarily have to re-qualify based on a higher interest amount.
Yeah, I like that one. I mean, I think that's interesting because I was been reading a little bit about that and talking to some clients about that, and at least it hopefully increases the competition. So someone's not just getting their 5-year renewal and then being told, hey, here's the best rate you can have, which I know you always tell me don't do that. You should always be talking to someone like yourself or at least even talking with the current lender to say, is this the best situation that you can give me right now? But, someone that's coming up for a 5-year, say, I know there's a lot of people that bought houses, obviously, when the rates were considerably lower. What would your advice be? Would it be to start having a conversation? How soon out from their renewal would you have those conversations with clients?
Typically 120 days. So we can usually secure new rates within 120 days before maturity. So that's usually the time frame. And I mean, even if we were to secure something earlier on, say, at the 120-day mark, I'm still monitoring interest rates, and we can get that rate floated down up until, a few business days before that maturity date. It's not, you're not stuck in that initial rate. I mean, I'm looking at rates every day. So.
Yeah. And I think one of the things with working with someone like yourself is that you're looking at it every single day. I said that to a client, I think a couple of days ago, where if they had have looked at 200 houses this year in London, they probably would know a lot more than they do now. And that's why they hire me. Mm-hmm. I've just been in a heck of a lot of houses, or I've seen a lot of houses, and I'm constantly just tracking what things are selling at and what the condition is. So it's kind of similar in that sense that you're constantly looking at the rates, looking how to qualify people, looking at, hey, this is a stumbling block. This is how we can fix it based on your experience that you have as well. Speaking of rates, what are you seeing in terms of the rates? And I know you don't have a crystal ball, like I always say on the podcast, but what are your thoughts on the December decision, which I think is this week, if I'm not...
Next week.
The 11th. Next week. And then what are your thoughts on where things are going in terms of fixed versus variable? Because it seems like the fixed haven't gone in the lower direction in the last little while. I'm curious on what you're seeing and what you kind of see could potentially happen in 2025.
So we are expecting the variable rates to decrease by a quarter point next week. A quarter point being a quarter of a percent, 0.25, which will provide a bit more relief to those who currently have a variable rate mortgage.
That's me, man. That's me.
Yeah, you've been riding the wave.
Yeah.
But as it stands right now, the discounts off prime for variable rates still aren't as favorable as going with a 5-year fixed or a 3-year fixed rate. They're getting better. They're getting closer. But when it comes down to it, many clients they're worried about cash flow on a monthly basis. So if you're worried about cash flow on a monthly basis, then, you kind of have to go with the lower rate, right? So I think heading into 2025, we will see further rate decreases. I don't think they're going to be as aggressive as initially thought of over the last 6 months, but I still think we will see some downward movement. One of the big things, and I know you mentioned you didn't want to talk politics, but is the Trump tariffs that you had mentioned. They might kind of force our hand into lowering interest rates sooner than intended. So we'll see, but I wish I had that crystal ball.
Yeah, like one of the things that I also heard too is that the federal government in Canada is also doing this, I don't know what we're going to call it. They're going to call it an HST holiday, but they're just saying, they're going to decrease or take away the HST on certain goods. And then I was reading an article about that saying potentially that obviously could impact the potential to do a more sizable interest rate cut because there'll be more flow. Hopefully, I guess that's what they're hoping for. I don't know if that's a good or a bad thing, but that people are spending money over the holidays and maybe saving a little bit of money. But that's a whole other can of worms, I guess, to open on that.
That's a whole nother episode.
Yeah, a whole other episode. We could talk just about that. Yeah, and I know Trump's tariff threat, I would call it right now, is interesting because it is, I think, we're such a smaller economy compared to the United States, and we're right next door. Obviously, we have an immense amount of trade with that country. So I think that's something that's a little bit of a curveball for everything that we've seen in the market. That said, I always say timing the market is usually not the best way to buy real estate, especially if and with my world, it's mostly people that are just buying a house for their family or selling a house for their family. So I think, be careful with that. But at the same time, I am interested to see what happens with the rates over the next little while. And in terms of when the variable potentially crosses that line and it makes potentially more sense for someone to go with that. But yeah, I think that might take some time to figure out. So quarter point next week, hopefully I'll be rooting for that, I think, in my little world. But that'll be interesting to see how that all goes over the next little while. So Spencer, I know we've had you on the podcast before, but I always appreciate you sharing your insight because these are questions that I always ask you about off when we're not on the podcast. So I think it's interesting to have you on to share your views with people. If they want to get advice on their mortgage, or maybe they're thinking about making a move, they need to qualify, obviously, for that, get a pre-approval done. What's the best way for people to get in touch with you, and what's your kind of process?
Best way is typically email. And I mean, I'm sure you'll share that information.
Mm-hmm.
Email is preferred, but I'm also open to phone calls, text messages, etc. That's typically best. And yeah, I'm more than happy to give anybody my opinion or my 2 cents on kind of what they should do. Like I said, and like I've told you many times, and I'm looking at this stuff day in and day out, and I'm doing the math for people to see if it makes sense to switch, right? So my bread and butter, and just making sure everybody's getting some sound advice.
Absolutely. Yeah, I can share all that in the show notes. What's your website?
So I'm at Spencer Murray Mortgages.
Okay. And you're with Indi Mortgages, right?
Correct.
Is that correct? Okay, cool. Okay, awesome. Yeah, Spencer, thank you so much for joining the podcast today. Anything else you want to add, or have we wrapped it up perfectly in a bow for Christmas here?
I would say it's nice. It's wrapped up pretty nice.
Okay, perfect. Well, we'll keep watching over the next few weeks, see what happens with interest rates, see what happens with those tariffs, I guess, as we get into the new year, when Trump actually becomes president, and we'll also see how these new rules affect the London area market. I'll leave you with kind of final thought here from me. What I'm seeing in the market over the last week or so, and again, this is only within my little world, I'm noticing a bit of a pickup in London. And I know people think this is crazy, but I've talked to several real estate agents in the last week or so. Maybe it's just the rush before the holidays. Things seem to be selling. I'm talking to agents that have had houses on the market for 60, 90 days, and now we're getting offers again, including me. So we're getting into a spot, I think, where there's a bit of a rush before the holidays, but we'll see what happens with interest rates and all the new mortgage rules and how that affects things for 2025. The holidays are almost here. I wish everyone a great holiday. I might do another one of these before the holiday, but if not, I hope you have a great holiday. My name is Phil Bailey. I'm a real estate agent in London with the HouseSigma team. You can get a hold of me directly. Just text me 226-977-2348. Or just go to my website. You can contact me through there as well and learn a little bit more about my approach and check out those Google reviews. My website is just www.philbailey.ca. Thanks again, Spencer, for joining the podcast. I hope everyone has a wonderful day and enjoy the snow out there today, London. Talk to you soon. Take care.